So could Japan be sitting on a nuclear bomb called debt? Currently, Japan's debt is 260% of GDP. How does that compare with the US? 120 to 125% of GDP. Now, everybody knows last week they were selling off Japanese bonds. So here's the real deal, though. Japan is sitting on 1.1 to 1 trillion of U.S. securities. So for years, for decades, you've had low interest rates in Japan. So now all of a sudden, the 10-year shoots up to 2.3%, a 27-year high. So if you look at the banks, they're saying that investment banks were saying for every 10 basis points in yield increase in Japan, it increases the U.S. yields 2 to 3 basis points. So if you think about it, a couple of weeks ago, the 10-year was at about 4.09, 12, 15, around there, right? And all of a sudden, Japan goes through their little scenario, and we're at 4.30s, like 4.21 when I looked at this morning on the 10-year. So what you're seeing is people on nerve. And it's going to trickle down into the U.S. market. Think about this. The carry trade. You have all of Wall Street leveraging dollars because it makes sense to get cheap money from Japan and leverage in the U.S. market. So all of a sudden, yields start to spike. That gets everybody nervous on Wall Street, and they're starting looking for liquidity because of margin calls. So there we go, the yen carry trade, no more free money. That's going to be out the window. The Japan long bond, they're having a problem with buyers. That 40 years is laying on 4%. So if you're looking at what's happening, the repatriation in Japan, and then the potential selling of $130 billion in U.S. Treasuries could spike the 10-year to about 4.5 to 4.7 and push that 30-year right through 5%. So what does that do for the market? A couple of things. Number one, mortgages, they could spike to 6.5 to 7%. Banks, well, they start losing their hair because what happens is they're searching for liquidity because on a couple of fronts, liquidity, capital, and funding. So here's the problem. Remember when we had the liberation scenario back, I think it was last April 7th, somewhere around there. So what was happening is equities were selling off and so were bonds. Equities and bonds were selling off, so everyone got nervous. So if you get the banking system, the investment banks who are long these 30-year treasuries, that's going to pretty much turn them to shriveled up pieces of bread. You got to look at it like this. They're going to be selling bonds. They're going to be trading down maturities. They're going to do a lot of things to shore up their balance sheet, which could dig into their capital, right? That safe capital that keeps the banking system sound. If that even gets around Wall Street, then you're going to see panic selling of the bond market, selling of the stock market. And there we go. Yields start to spike. Mortgage rates are up there. That's going to slow down the real estate market. Small businesses get affected. Credit starts to shrink, right? And so when you start to see that happen, then we could be looking at going into that recession if it does. This is a big deal. And while they're not talking about it, look at the dollar dropping, right? And pay attention to Japan, all right? I know we got AI. I know a lot of things are happening in AI, but pay attention to Japan. That is just my fair warning right now, because this could get a little bit more hairy.